All right, let's jump right into it. Today, we're unpacking what I think is one of the most absolutely fascinating shifts happening in the global financial landscape right now. We're pointing our radar at Japan. Now, for decades, this is a market that honestly got totally overlooked. But suddenly, it is commanding everyone's attention. So today, we're going to demystify the EWJ ETF. If you're a beginner investor and you're thinking about adding some international flavor to your portfolio, getting a handle on this specific fund is a brilliant starting point. We're going to break down exactly what it is, how the mechanics work, and the underlying macroeconomic forces that are driving its recent surge.
Listen to this quote for a second. Analysts are straight up calling this moment the definitive end of Japan's deflationary lost decades, and that's a huge statement. For roughly 30 years, Japan's economy was kind of the ultimate cautionary tale in investing. We're talking stagnant growth, falling prices, and corporations that just stubbornly hoarded mountains of cash instead of investing it or giving it back to shareholders. But you guys, that narrative has completely flipped. What we are witnessing right now is a legitimate, once-in-a-generation awakening. And for U.S. investors, the EWJ ETF is basically the most direct front door into this historic shift.
So here's our game plan for today's explainer. First, we'll look at Japan's shift. Second, we'll officially meet the EWJ ETF. Third, what are you buying? Fourth, costs and returns. And finally, we'll tackle the currency risk catch.
Part 1. Japan's once-in-a-generation shift. Okay, let's dive into this. Because to really understand the investment vehicle, we have to grasp the big picture environment it's operating in right now.
This timeline really puts the whole shebang into perspective. Back in the 1990s, Japan's massive asset bubble burst, and that kicked off a really grueling period of deflation. Fast forward to December 2025, and boom, we hit a monumental milestone. The Bank of Japan actually hiked interest rates to 0.75%. Now, I know 0.75% might sound like a drop in the bucket to us, but for Japan, that was the highest level in 30 years. It officially signaled the end of the negative interest rate era. At the exact same time, moving through 2026, we are in an era of aggressive corporate governance reforms. Basically, the government and the stock exchanges are putting heavy pressure on Japanese companies to finally start treating their shareholders better. It's a fundamental shift in the whole investment thesis.
So, what does this all mean? Well, these structural shifts creates a massive macro tailwinds. The end of negative rates? That's a huge deal. It means Japanese banks can finally expand their net interest margins, so they can actually make real money on the spread between what they pay out to depositors and what they charge for loans. Plus, because of those governance reforms, companies are finally cracking open those historic cash reserves and returning them to shareholders through dividends and stock buybacks. It's exactly why Japanese equities are just so exciting right now.
Section 2. Meet the EWJ ETF. With that macro backdrop in mind, let's look at the specific tool we're exploring today.
Let's strip away the financial jargon here. EWJ is the ticker symbol for the iShares MSCI Japan ETF. It was launched by BlackRock way back in 1996, and it tracks a market cap-weighted index. In plain English, that just means it buys a massive basket of Japanese stocks, and the bigger the company, the larger the slice of your investment it gets. Because it covers about 85% of Japan's entire investable universe, it's pretty much the most straightforward way for a U.S. investor to buy a broad slice of the Japanese economy in one single trade. No crazy derivatives, no complex options, just pure, simple equity exposure. And to give you a real sense of just how established this fund is, look at this number. Over $21.2 billion in assets under management. That is billion with a B. That massive scale tells us this definitely isn't some obscure, fly-by-night fund. It's a highly liquid, incredibly mainstream ETF that both massive institutions and everyday retail investors use to get into the Japanese market.
Section 3. What are you actually buying? When you hit that buy button on EWJ, what exactly is going into your portfolio?
Now, what's really interesting about this breakdown is how the fund is weighted. Think of an ETF like a giant shopping basket. When you peek inside the EJW basket, it's heavily tilted toward the industrial and financial backbone of Japan. Industrials take the top spot at around 24%. Then you've got technology at roughly 19%, which perfectly captures Japan's critical role in global tech and semiconductor manufacturing. Financials sit at 18%, and remember, those are the guys directly benefiting from those rate hikes we talked about. And finally, consumer discretionary comes in at 15%.
And here's where it gets super real.
These are the actual top companies you own a slice of when you buy this fund. You've got Mitsubishi UFJ, which is one of those massive banking groups loving the higher interest rates. But look at these other names: SoftBank, Toyota, Sony. For a beginner investor, seeing incredibly familiar, dominant brands like Toyota and Sony gives you a lot of confidence, right? You aren't just buying abstract data points on a spreadsheet, you're buying into recognizable global powerhouses.
Section 4. Dividends, costs, and returns. Let's crunch the practical numbers that matter to your wallet. What's it cost to hold, and what does it pay out? First up, the expense ratio. It sits at 0.49%. To put that in perspective, for every $100 you invest in this ETF, you're paying 49 cents a year in management fees. Now, sure, that's slightly higher than a bare-bones U.S. index fund, but for comprehensive international exposure in a fund this liquid, it's considered very reasonable.
Next, check out the dividend yield, which recently clocked in at 4.02%. This is a huge selling point. EWJ pays out these dividends semi-annually. Remember those corporate governance reforms pressing companies to stop hoarding cash? Well, as those businesses finally return that cash to shareholders, those funds flow directly through to you as the ETF holder.
And then we have the performance headline. Over a recent one-year period, EWJ delivered a total return of over 28%. That is phenomenal. It completely reflects the intense optimism surrounding Japan right now. But, and this is a really big but, you can never just look at the headline return. There is a massive catch to these numbers, and it's something every single beginner absolutely has to understand when buying foreign assets.
Which brings us perfectly to Section 5, the currency risk catch. This is essentially the climax of our explainer, where we unpack the single most vital concept for international investing.
Okay, so EWJ is what's known in the biz as an unhedged ETF. What does that actually mean? It means that when you buy it, your returns are completely exposed to the exchange rate between the Japanese yen and the US dollar. See, the underlying stocks are priced in yen, but you are buying the ETF using US dollars. So by default, you are taking a long position on the yen. If those Japanese stocks go up 10%, but the yen simultaneously loses 10% of its value against the dollar, your return as a US investor is basically wiped out. Poof, gone. And this brilliantly illustrates the mechanics of that risk. Let's compare EWJ with its hedged counterpart, the DXJ ETF. EWJ is unhedged, meaning a weak yen actively eats away at your dollar returns. DXJ, on the flip side, uses financial instruments to completely neutralize that currency risk. It essentially shields your returns when the yen is weak, letting you capture the pure performance of the underlying stocks without the currency drag pulling you down.
Let's look at the real-world impact of this over the past year. The dollar-to-yen exchange rate traded near 157.76, which is a historically weak yen. And because of that persistently weak currency, the unhedged EWJ returned around 27.4%. Fantastic, right? But look at the hedged DXJ, which was protected from that falling currency. It returned a staggering 45.9%. That massive, almost 20% performance gap between the two funds over the exact same period was almost entirely caused by currency fluctuations eroding the purchasing power of the unhedged investors. However, it's absolutely vital to remember that currency is a two-way street. Yes, a weak yen hurt EWJ recently, but economic winds shift. As the Bank of Japan raises their rates, the yield gap between Japan and the US starts to narrow. If that causes the yen to strengthen against the dollar down the road, that currency drag suddenly flips into a currency tailwind. In a scenario where the yen is recovering, an unhedged fund like EWJ is structurally positioned to actually outperform those hedged alternatives. So it really all boils down to your personal view on where the currency is heading next.
So, as we wrap up this explainer, I want to leave you with a bit of a provocative thought. We've seen today that Japan is undergoing this fundamental, generation-defining shift, ending deflation, raising rates, and rolling out massive corporate reforms. You now know exactly how the EWJ ETF offers a direct, highly liquid way into this market, and you understand the underlying mechanics of unhedged currency risk. So ask yourself, with the third largest economy in the world finally waking up from its slumber, is your investment portfolio perhaps just a little too US-centric? I really hope this explainer gave you the clarity to explore that question for yourself. Thanks so much for hanging out with me today.